Imagine walking into a giant marketplace. Except instead of fruits and vegetables, people are shouting prices for Apple, Tesla, or Amazon. That's basically the stock market. It looks chaotic. But behind the flashing numbers is a system that's been running for centuries. And here's the real kicker. The rules that drive today's trillion-dollar markets started with ships, coffee houses, and handwritten agreements under a buttonwood tree. Stick with me, because by the end of this video, you'll know not only how the stock market works, but also the fascinating history that made it possible. And hey, if you've ever wondered why a random news story can wipe billions off a company in seconds, yeah, we're going to cover that too. So let's break it down. The stock market is not some secret club. It's simply a place where people buy and sell pieces of companies. When you buy a share, you literally own a slice of that business. If the company does well, you win. If it fails, you feel it. Prices go up and down based on one basic rule: supply and demand. More buyers push the price higher. More sellers push it down. To make this happen smoothly, we've got exchanges. The New York Stock Exchange, NASDAQ, basically giant matchmaking services for buyers and sellers. At its heart, the stock market is a tool. It gives companies money to grow, and it gives investors the chance to grow their own wealth. Simple idea, massive impact. The stock market didn't appear overnight. It grew out of centuries of experimentation, with trade, with money, and with risk. The very first recognizable stock market began in Amsterdam in 1602. The Dutch East India Company became the first business in history to issue shares to the public. Back then, sailing to Asia for spices was a dangerous gamble. Ships could sink, pirates could attack, storms could destroy the cargo. So instead of one wealthy merchant funding a voyage alone, the company sold shares to investors. Everyone contributed smaller amounts of money, and in return, everyone shared the profits or the losses. It was the birth of modern investing and risk sharing. From there, the idea spread quickly. In London, traders gathered in coffee houses to buy and sell shares of shipping companies and other ventures. These noisy gatherings eventually formalized into the London Stock Exchange in 1801. Coffee, conversation, speculation. Together, they laid the foundation for one of the world's most powerful financial centers. Meanwhile, across the Atlantic, the United States was carving out its own financial system. In 1792, under a buttonwood tree on Wall Street, 24 brokers signed the Buttonwood Agreement. This simple deal set the rules for trading stocks and marked the beginning of the New York Stock Exchange. That little patch of ground would grow into the beating heart of global finance, shaping economies worldwide. For centuries, stock trading was done in person. Frantic hand signals, shouting matches, stacks of paper certificates. The 20th century brought huge milestones. The Great Depression of 1929, when reckless speculation led to an economic collapse. The post-World War II boom, when stock ownership became part of everyday savings. And the rise of institutional investors, like pension funds. By the late 20th and early 21st centuries, technology reshaped everything. In 1971, the launch of NASDAQ marked the first electronic exchange. Trades were processed digitally instead of face-to-face. Computers soon replaced paper slips. By the 2000s, high-speed internet and trading algorithms were running the show. Today, you don't need to stand on a trading floor. You can buy a stock from your phone in seconds. From risky voyages in the 1600s to smartphone apps in your pocket. The history of the stock market shows how human ambition, risk-taking, and technology built the system we now take for granted. Here's the thing, businesses need money to grow. Let's say a company wants to build a new factory. They could take a loan from a bank. Or they could raise millions by selling small ownership stakes, shares, to the public. That's what's called an IPO, an initial public offering. For the company, it's a way to get cash without piling up debt. For investors, it's an opportunity. If the company becomes the next Amazon, early shareholders strike gold. So really, the stock market is a win-win system. Companies get the fuel they need to expand, and investors get the chance to ride that rocket. It's one of the biggest reasons economies grow the way they do. Now, let's talk about the fun part, trading. The basic rule is simple. Buy low, sell high. But in reality, it's a mix of strategy, timing, and sometimes pure luck. You place your order through a broker or an app. And somewhere, someone on the other end agrees to take the opposite side of the deal. Prices shift every second based on supply and demand. Good earnings? The price jumps. Bad news? The price tanks. Some people buy and hold for years. Others day trade, flipping stocks like sneakers. But no matter the style, the principle stays the same. The market is a giant auction house where ownership of companies changes hands constantly. So, who's actually moving all this money around? First, you've got retail investors. Regular folks like you and me. Then, there are institutional investors. Giant funds that manage billions like mutual funds or pensions. They can sway the market with a single trade. Market makers step in to keep things flowing. They're always ready to buy or sell, so the system doesn't freeze up. Brokers act as the middlemen, connecting buyers and sellers. And finally, regulators like the SEC. Their job is to make sure nobody cheats the system. Together, these players keep the stock market from collapsing into chaos. Well, most of the time. Here's why you should care, even if you never plan to trade a single share. The stock market affects your daily life. Retirement accounts, pensions, even your future paycheck. Many are tied to stock performance. Companies raise money in the market. Then they use it to hire workers, build products, and grow industries. When markets soar, economies often thrive. When they crash, everyone feels it. Jobs disappear. Savings shrink. Global trade slows. In short, the stock market is not some distant casino. It's a mirror of economic health that touches almost every part of modern life. Now for the catch. The stock market can make people rich, but it can also wipe them out. History is full of painful reminders. The crash of 1929, that kicked off the Great Depression, the dot-com bubble in 2000, and the financial meltdown in 2008. These events show that markets are powerful, but fragile. That's why smart investors diversify. They spread their money across different companies, industries, even countries. No system is risk-free. But the stock market rewards those who balance patience with strategy. High risk, high reward. That's the game. Today's market barely resembles its past. Trading floors filled with shouting brokers? Almost gone. Now, algorithms make trades in milliseconds. Information travels so fast that a single tweet can send stocks crashing or soaring. This technology makes investing easier, more democratic, but also more unpredictable. Anyone with a smartphone can join in, but it also means the market reacts instantly to global events. It's faster, it's louder, and it's riskier than ever before. So there you have it. The stock market, from Dutch ships to trading apps. It's not magic, and it's not just gambling. It's a system where companies raise money, investors take risks, and economies are built. Sometimes it creates billionaires. Sometimes it creates chaos. But it always reflects human ambition and fear. If this video helped you understand the market a little better, hit that like button. Subscribe for more breakdowns. And drop a comment below. Do you think the stock market is an opportunity or just organized chaos?